In the previous video, I looked at the cash journals, the cash receipts journal, the cash payments journal, and the petty cash journal. I looked at the documents that we used to record the cash transactions and which journals the transactions were recorded in. In this video, I'm going to have a look at credit transactions. I'm going to look at credit sales, credit purchases, and I'm going to look at sales returns and purchases returns, and then we'll have a look at the general journal as well. The important thing here is to be able to identify the documents, whether they're the original or the duplicate documents, which journals are used to record specific transactions, and you must be able to complete this information on the accounting table. We looked at this. We're going to look now at credit purchases, credit sales. There it says credit sales returns, and most probably general journal transactions. We're going to look at documents. Specifically here, we'll look at invoices, debit notes, credit notes, and then we're going to look at the sales or debtors journal, sales allowance journal, or debtors allowance journal as it's also known as, the purchases journal, purchases allowance journal, and the general journal. We might look at a debtor and a creditor's account. We will see. Right, so we're going to move quickly on to the sales journal, or also known as the debtors journal. In this journal, all credit sales are recorded. So if we look at on the 9th, sold goods, stock, trading inventory to the school on credit, 2,500. We sold the stock for 2,500. The stock originally cost us 1,000. That's why it says the cost price was 1,000. And we used an invoice to record this sale. Now what happens is Calibu Education is selling to the school on credit. The school has an account with Calibu Education to buy on credit. The school receives goods now and pays later. Calibu will issue a tax invoice, a credit invoice to the school, like that. And Calibu is left with the duplicate copy, and the duplicate copy is used to record the transaction. So all credit sales, an invoice is used to record the credit sale, and the person selling, or Calibu Education in this case, will record the transaction using the duplicate, as the original will go to the account holder, the school. And this transaction is recorded like this. It happened on the 9th. Invoice number 21 was used to record this transaction. The duplicate was used as the original went to the school. Which journal was used to record this transaction? You can either write sales journal or debtors journal. Same thing. Now there are two parts to a sale, as you well know by now. This was a credit sale, so the account that gets debited is accounts receivable. Account credit is sales. Accounts receivable, increase in assets. Sales, increase in income. That's why the asset was debited and the income was credited with the selling amount, 2,500. The second part is to record the cost of the sale. Debit cost of sales, why? Cost of sales is an expense. Increase in expense, the rule says debit. Trading inventory has now gone to the school. We no longer have that stock on our books. That is a decrease in assets. A decrease in assets, the rule says credit, with the original or historical cost price amount of 1,000. That is a sales entry a credit sales entry in the sales journal. This is an example here of a sales journal. In this case here, all invoices which invoice was used, the duplicate, there was only one debtor, the school in this example. You can have many, right? You could have Pearson, Alex, Collegiate, Westring, selling to all those different schools on credit. And those are the columns, and then you total up. This, by the way, is the amount of credit sales for the month. But you're not going to have to write up the journal. You're going to do the table. These here are transactions just of credit sales. They're all credit sales. We've done one. You know how to do it now. If you don't, go back in the video and watch that first sale recorded in the accounting table again. Now there's a sales returns or debtors allowances journal, same thing. Now the school might not have been happy with everything that was sold to them on credit. And then what the school does is returns the goods. So in this transaction here, it says the school wasn't happy with the stock that was sold to them on the 9th, invoice number 23, and requested a 20% credit. We granted their request and issued them a credit note number 54. Right, we issue a credit note saying that we are going to credit their account if we agree with their claim for goods that didn't comply with the order. So these are examples here of returns, and we are going to issue a credit note, and that's a tiny credit note there, just an example of the document. And this here is an example of the debtors allowance journal or sales returns journal, right? It's up to you what you're going to call it. Maybe stick to what's in the text. I think it said sales returns in your textbook. Right, now let's just trace what happens when a customer that has an account with us sends goods back. And I'm going to tell you a little bit of insight, more than what you need to know. But I want you to know it. Now what happened was the school wasn't happy. So on the 15th, the school sent a debit note to Calibu Education for stock that did not comply with their order. So a debit note is being sent by the school to Calibu Education saying that certain goods weren't ordered, but something was wrong with the order, and the goods are getting sent back. Now in the school's books, that's a T account, Calibu Education is a liability, which means it will have a credit balance. Now the school is saying that they're going to debit, that's the debit side of the T account, Calibu Education's account in their books. That's why they are sending a debit note. A debit note is a claim for goods which do not comply with the order. Wrong goods, right? The school's not happy, sends the goods back. They send a debit note. Now Calibu Education, we are Calibu Education, checks, is their claim legitimate? That means, do they have a reason to be unhappy? And Calibu does the check and finds that Calibu, us, we made a mistake. So we are going to give them a credit, because in our books that says the school, right? is an asset. Accounts receivable, so you have to know prior work to understand this. The school, which is a debtor, is an asset. It has a debit balance, but we are going to give them a credit to the value of their claim. And what Calibu does then is they send the school a credit note, and the school gets the original. And what does Calibu keep? The duplicate. You need to know your work well to understand exactly what's happened. You can watch this again, but I'm going to jump ahead now, and I'm just going to show you what happens when we record a transaction in the sales returns debtors allowance journal. So Calibu accepted that and sent a credit note. That's what that says there. And there we go. The credit note was sent to the school. And what was left with us, Calibu Education? The duplicate copy. And that duplicate copy is going to be used to record the transaction. I've put in here a return and a credit sale. Now, a credit sale, I'm going back. This stock was sold to the school, 2,500. The account that was debited was accounts receivable, sales. This is a credit sale. Debit cost of sales, credit trading inventory, and that was recorded. This was recorded in the debtors journal, the sales journal or debtors journal. That was the original sale. Now the school got the goods that they had paid 2,500 for, and they weren't happy. So that was the credit sale. Now we're looking at the return. The school sent a debit note. We agreed to their claim for goods that didn't comply with the order, and we sent a credit note. We sent them the original, and we left with the duplicate, and we recorded. On the 15th, they weren't happy with 1,500 Rand worth of stock of the 2,500 that they had bought. We issued a credit note. We are left with the duplicate. The information was recorded in the sales return journal, or you can call it the debtors allowance journal. The account that was debited is sales returns. Some textbooks will debit sales straight away. So you could have just had sales or sales returns. Sales returns, by the way, gets closed off to sales at a later stage. But account debit, sales returns. Account credit, accounts receivable. Account debit, trading inventory, account credit, cost of sales. Basically what's happening here is we are reversing the sale, 1,500 worth of the sale, and stock has been returned back onto our shelves if it wasn't damaged. But my point is, look, when trading inventory in the sale was credited, now we're getting it back, it is debited. Increase in assets. Cost of sales is reversed because we got the stock back. So cost of sales was debited, now it is credited. Accounts receivable was debited, but now we're reversing that by crediting it. And sales was credited, but now it's going to be debited. That's why I showed this original transaction, because I wanted to show you how a sale and a return compare by putting both transactions on one slide. So I'm going to do that again just quickly. I've got here the original credit sale. The school wasn't happy, so they returned. The original sale, the document was an invoice. Now there's a credit note involved. Accounts receivable was originally debited, now it's credited. Sales was originally credited, now it is debited. Cost of sales was originally debited, got to reverse it, now it's credited. Trading inventory was credited and now it is debited. Go through this one again. Hopefully quite a few more, you go through quite a few more in the tutorials. Let's move on. Right, so we've got here now a purchases or a creditors journal. So I've been through the sales journal and the sales returns, which is also called the debtors journal or the debtors allowances. Now we are going through credit purchases. Right, the creditors journal or the purchases journal records the purchases of items bought on credit. For example, purchased on credit a new printer from our supplier, the computer store. They sent an invoice to Calibu CS78 for 1,350. It goes into the purchases journal or the CJ, which is the creditors journal. The date was the 18th. The document, there it is, invoice. And what are we getting from the computer store? That is the original. Where we're recording a credit purchases in the purchases journal or creditors journal. What did we buy? I'm calling this printer equipment. What is equipment? An asset. Increase in assets, the account must get debited. But we bought this on credit, so now we have a liability. And an increase in liability, the account must get credited. And what is the account? Which records items bought on credit, accounts payable. And the amount was 1,350. So there we go. That's a purchases creditors journal. Right, then also, if we're not happy with the items that we bought, we return the goods to the supplier. So this is returned inferior stock. We got a 50% rebate. Calibu was overcharged. Those are reasons why, or transactions why we would record, reasons why we would record these transactions in a purchases returns journal, creditors allowance journal. But let's just say, to keep it simple, we return some of the items that we bought. There's an example of a creditors allowance journal or purchases returns. And let's look at a transaction. So what has happened here is Calibu returns stock of inferior quality to the computer store. They said they're going to credit to our account. So they send us, Calibu Education, a credit note, which is the original. The date is the 8th. We use their folio reference here, or their reference, document reference. Credit note, computer store number 1. We are recording this information from the original document. Which journal is this recorded in? The creditors allowance journal or the purchases returns journal. We're going to debit accounts payable because we owe less. It's a decrease in liability, the rule says. Debit. And what did we send back? Trading inventory. So the value of our stock on hand has decreased, the rule says credit. And the amount was 12,000. So there we've recorded that information. And that's an example there. Another one of a creditors allowance journal, purchases returns. Write the general journal. Any transaction that does not fit into any of the other journals gets recorded in the general journal. The document that is drawn up is an internal document called the journal voucher. So the journal voucher is an original. So if the owner makes a capital contribution of a delivery vehicle, it goes through the general journal. Interest on a loan goes through the general journal. The owner takes stock for his own use, goes through the general journal. So here with the general journal, any transaction that doesn't fit into any of the other journals gets recorded in the general journal. Right, this is the second video. The important thing from the two videos that I've just created is you need to know what document was used in the transaction. Was it the original or was it the duplicate? You need to know which journal is the transaction recorded in. Then obviously the account that was debited and the account that was credited and the amount. That is important information which you will be required to complete on a table. Right, when you finish this, you can go to the link which will give you questions on this video. Enjoy the little assessment. See you soon. Cheers. Bye. Just before I go, I want to show you just an example of a general journal. Under details, you're going to have the accounts that are debited and credited. This is slightly different to all the other journals. You've got a column for debit and a column for credit. Remember, in the general journal, you've got all transactions that don't fit into the other journals. The document is the journal voucher, which is a document that's drawn up internally. And that's all, folks. The end. Chat soon. Cheers. Bye.